Let's everybody welcome Mary Soldano, who is an SBA loan broker, and she's going to talk to us today about acquiring real estate with an SBA loan. Welcome,
Yes,
Mary.
Thank you. Thank you so much. I'm not a loan broker, but I'm actually the SBA lender. So there are a lot of SBA loan brokers out there in the country that they're part of our referral partners. Some of you may become one day. It's like people do it as like a side hustle and they love it because you get paid by the lender for bringing in an SBA loan, but we are the actual firm that lends the money. So just wanted to let you all know that. And so SBA financing, I do have a PowerPoint. Am I okay to share? Hit present now?
Yes. Will it let you share?
I think so.
Perfect. We can see it.
Awesome. Do you see it in the slideshow mode?
Yes. Well, no, it's in the mode where we see your slides on the side as well. But that's probably okay with us.
As long as it's okay with you guys. I am not the most tech savvy.
Maybe get rid of the notes area at the bottom to make the slide a little bigger.
There you go.
There we go. That works.
All right. I apologize. Awesome. So SBA can also be used for owner-occupied commercial real estate. It's actually the #1 use of proceeds in the United States of the SBA 7A program. So while a lot of us think of it for business acquisitions or debt refi, commercial real estate is actually the #1 use of proceeds amongst all SBA loans in the country. Just, brief info about me. I work for Fundex Solutions Group. They're a non-bank SBA lender. So in the country, there's over 1,800 SBA lending institutions. 14 of those have a license to do special SBA lending that are non-banking institutions. And so basically the perks of that is that we don't require any bank accounts. We don't require full relationships. And we have a little bit more of a robust credit box where we can offer up to 100% financing, for example, that I'll get into later. And so I've been doing SBA my entire career, started out in SBA micro lending in Philadelphia, and now I'm doing SBA 7A lending for the past probably about 4 or 5 years now. And so a little bit about SBA 7A loans. Specifically, this is all geared towards owner-occupied commercial real estate since we're talking with all of you guys today. So loans range anywhere from $350,000 to $5 million. So $5 million is the max SBA loan exposure. We do lend nationally, so we would lend anywhere on the West Coast to the East Coast to middle of the country. Our average loan size last year is about 1.3 million, and we did over 130 million over the last 12 months. Under the SBA 7A program, there's a bunch of different things you can use it for. So today I'm going to really focus on the commercial real estate aspect. But you can see here, you include construction, FF&E, you can refinance business debt, business expansion, buying out a partner, buying a business. There's a lot of different things you can use it for. And the cool thing about SBA 7A is that you can buy a building and also do one of these other things as well. So we actually see a lot of business acquisitions that also come with real estate, or we see somebody wants to buy real estate but make minor construction improvements to it. Or they're buying real estate, but they're also refinancing some debt as well, all under the same business entity. So it's pretty cool because then you don't have to take out multiple loans for that one thing. So there are different eligibility criteria for SBA, and this all stems from the SBA SOP. So if you want to put yourself to sleep at night, you can download the 600-page rule book for the SBA and go through and read all of it. Or I can just send you the snippets that matter for the commercial real estate portions. So these are the top line eligibility stuff. So you must be a U.S. citizen or legal permanent resident, must own at least 51% of the company. You could have others who are not legal permanent residents as long as they are not the majority owner of the business. The real estate also must be owner occupied by at least 51% of the usable square footage of the building. So for example, take like a 2-story place in a city. The first floor is a pizza shop, second floor is an apartment. As long as that pizza shop has one more square foot than the second floor, you can utilize SBA 7A for that. You must be a for-profit business, and the business cannot promote religious beliefs and operates under all U.S. federal laws. They file taxes, they pay their taxes, and the person must actively manage the business. Over the last couple of years, actively manage has been something that, there's a lot of different interpretations of it. And so we really look at it as a deal by deal basis. Let's say you own it and you're spending maybe 10 hours a week doing staffing schedules and managing the finances. That could still count as actively managing the company. When we get into structure of SBA, specifically for commercial real estate, there's something called EPC and OC. So since we're, everybody here is involved in real estate investments, you'll probably do a lot in real estate holding entities. And so an EPC is basically the SBA's form of a real estate holding entity. It's literally just the SBA's acronym for eligible passive company to allow the small business to be able to have that LLC for tax purposes. Like for example, it could be, 123 Walnut Street LLC, and then OC is an operating company, which is the small business, like a pizza shop. And so both the EPC and the OC, so your real estate holding entity and your operating company, would co-borrow the loan for a term of 25 years. That term of 25 years also fully amortizes. There's no balloons, no loan covenants, no, we do review financials annually, but if you fall below like a certain debt coverage ratio, they do not ask you to leave. They just work with you like, hey, how can we help increase your financial position? To pre-qualify, a lot of lenders in the country do this where instead of submitting a deal, this is the same thing that if you were going to a conventional bank to get like a term sheet, this is what we call our pre-qualification process. So review items from both the business and the personal. So business, we look at 3 years tax returns, interim financials, and a debt schedule. Personal, we just want to see the stuff that anybody who owns 20% or more of the company, these items: personal financial statement, 3 years personal tax returns, what they think their credit score is, and a resume. And then qualifications, similar to conventional financing, they're going to look at the cash flow, collateral, liquidity position, your credit, character, experience, industry, and external forces. I always say the two biggest things that an SBA lender is really looking at is cash flow. Cash flow is always king, and it must be the operating entity that can service the debt service over the course of the loan, and management experience. And so they want to make sure like this person who's running this company can manage it well. What in their background can we translate to them managing this? Usually if we hit those two things, then we can figure out the rest. Credit is always important, of course, but we look more at the story behind the credit score. It's rare that you're doing a lot of SBA loans for people who have like 780, 800 FICO scores. You do see a little bit lower credit scores, but you're really getting to know why their credit is that way. It could be a short credit history, or they don't have enough credit out. Or we look at, hey, did life happen to you a few years ago and your credit is still affected by that, but everything before and after that life event has been paid timely. So SBA is a lot about the story of the person you're lending to, their small business, and can the cash flow support the debt service. And then here's some very specifics for an SBA commercial real estate. So I mentioned earlier the 51% owner occupant rule. So I drill on this anytime I'm speaking with a prospect or somebody that is looking at buying commercial real estate, because if you don't occupy 51%, or you start the process and then the appraisal comes in and it shows that you're less than 51%, the loan is done. There's no way we can do it because it's ineligible and the bank's loan won't be guaranteed. So that's a huge thing. And so usually you can figure that out by like an old appraisal, or this, like you get square footage when you're working with somebody who you're buying the business. So that is like a huge thing. If you're looking at utilizing SBA 7A, first question SBA lender is going to ask you is the owner occupied 51%? I mentioned earlier as well that the operating entity must support the debt service. So globally, it may cash flow great with, let's say they're renting out 2 apartments on top and they're operating the whole first floor. but SBA requires that the operating company can support that debt service. And then that additional revenue is just kind of gravy for the loan. We do a lot of rent replacements. So we see oftentimes somebody's been renting the same space for a while, and now the landlord is looking to sell and they have first right of refusal, they can buy their building. We see a lot of up to 100% financing with those rent replacements as well. And so to qualify for 100% financing, you have to be an operating business. So you can't be a startup, but it has to be somebody who's been in business for at least 1 full year, and it has to cash flow. And there must be a little bit of equity on the balance sheet. So basically, as long as you don't have more liabilities than you do assets and equity, then you can get up to 100% financing. And so people are always very confused about that. So that's one of the greatest perks of SBA 7A is the 100% rule. But that doesn't mean that you, let's say a building is worth $1 million and the loan is 1.25. So we really look at it's called 85% loan to value. And if there's a shortfall, this now depends on the SBA lender's specific credit box. So I always try to also be careful when I'm speaking with someone about what the SBA requires versus what's an SBA lender requirement. So the SBA SOP, that's the list of rules that we all have to abide by. And then there's SBA lenders in the country who may have credit boxes on top of that rule box. And so one of those things is, yes, SBA allows for up to 100% financing as long as there's equity on the balance sheet. Many lenders, especially today, are really tightening their credit boxes, and they're saying, nope, we still want, 85% LTV, 75% LTV. And that's where a lot of those non-bank SBA lenders, like myself, and there's a few other ones out there, they come in and they say, hey, we don't really care about the collateral because we lend on cash flow. So cash flow is king. And so as long as we are cash flowing well, we'll still lend you the full amount up to 100% of your need. And so what happens with the shortfall? So the shortfall, let's say, the building doesn't get us up to the $1 million loan that we're looking for. We would then look at the business assets of the company and pledge that to the loan. So we would take a UCC lien on all business assets. And then if we still have a shortfall, we would look at personal assets of our guarantor. And that's where we could take either a second or a third position lien on their personal real estate or investment property. However, that building must have at least 25% of equity in order for us to do that. So I know I'm kind of getting into the weeds with the 100% financing, but that's always what everybody wants to talk about because it's no money down. And so basically, if you don't have 25% of equity, then we don't have to take it. For example, I did a loan, this was back in October. It was about $1.5 million for a trucking company in Michigan. They didn't have any equity in their home or their investment property. So we're still able to offer 100% financing for them. And in lieu of taking additional collateral, we were able to take an assignment on life insurance, which can be on a new policy or an existing policy that they have. And then that mitigates it for the SBA, which is a really cool thing that a lot of small businesses can do. And we see it popular in a lot of cities where people are renting their home, but they want to buy a building for their business, but they don't have enough collateral put down. So a conventional lender is not going to touch them. That's where SBA 7A really comes into play.
Hey, Mary, we've got a couple of questions around the 51% owner.
I'm sorry. I don't see you. Thank you.
No problem. And I'll keep track of the questions for you and try to judiciously interrupt you so you can concentrate on your speech. But Shay is asking, if I buy a CRE partnership where I'm 50-50 with somebody else, can I get an SBA loan given the 51% rule?
So it's the 51% rule is on the operating company. So it depends on what is operating out of that business. So would you be owning 50% of the business that's in operation or 50% of that like real estate holding entity?
I'm guessing that they would not be owning the business that's in there. So it'd be like, a duplex that you rent out or an apartment building where you're renting out the actual apartments. But maybe it is. Maybe it's a home or a short-term rental, I guess Shay would have to slip in there, but clarify both sides.
Sure thing. So unfortunately, you cannot use SBA for strictly real estate investment purposes. There must be an operating entity component to that. However, the real estate holding entity can have a different ownership structure than your operating entity. So for example, let's say you want to go 50-50 in with the owner of that operating company. Let's say it's like a pizza shop that runs out of the building and the second floor is apartments. As long as that pizza shop is okay guaranteeing the loan and being a co-borrower, you could then go 50-50 in the real estate holding entity LLC. Does that make sense?
I think it does, but people can put questions in the chat. All right, we have another question here about you just gave an example of a business that qualifies for a 51% rule. I'm sure you've come across multiple others. Could you just give us one more example?
Yeah, of course. So I'm trying to think of something that's not like a two-story that I've done. I did a bakery not that long ago that was basically, it looked like it was a really long rancher, but it was actually like multiple units inside. And so they wanted to purchase the building and their square footage was 51% more of the total square footage of the building. And so that's where you get really technical with the realtor and who you're talking to. So you want to make sure that that operating company is literally just 1% bigger than the total square footage of the entire building. So if it's 100 square feet, you want to make sure the company who's co-borrowing on the loan is at least 51% occupied. Does that make sense?
Yeah. Yeah, it sounds like it's a good opportunity for a business that's leasing a space to maybe approach the owner and negotiate a purchase of the building, if
Yeah.
that would work out in their favor, or even if they were just the largest, like the anchor tenant in the building.
Yeah.
Okay. And then 100% debt financing. Oh, let's go over to some of the other questions here. Mario is Misi is asking, can you talk more about the on assignment of life insurance? That was an interesting comment.
Yeah, of course. So basically, we would take that if we do not have enough collateral to secure the loan. So let's say we're short $250,000 to be fully secure. We would then ask you to either get a new life insurance policy or if you have an existing one, and we are not the beneficiary. And when I say we, I'm talking about we as the bank and we as the SBA lender. So we would not be your beneficiary. You would tell your agent, hey, I have a bank who wants to be assigned as collateral to this policy. And so they would then give you a form. Usually I say, hey, let me just talk directly to the agent. It doesn't cost you anything to assign somebody as collateral. It's just a form that we fill out and then they sign and they acknowledge. So if God forbid something were to happen, whatever that amount is, if it's, let's say you have a policy for 500,000, but our shortfall is only 250, it would go to secure that 250. The rest would go to your beneficiary. And so the reason why the SBA does that is because they're lending so much on cash flow and management experience that if something were to happen to the owner who we're lending to, that business could then fall apart, right? And so that's why instead of feeling fully collateralized and being able to not have to say no to folks, they use that as like a mitigant.
Okay. Mario is asking, can you compare loan terms versus residential versus commercial? Sounds like it might be higher rates for the SBA. There's a lot of questions we can dive into there, and I've got a lot because this group has a lot of experience with, commercial property loans and residential loans, but not so much with the SBA. So what are the pluses and minuses to SBA versus like a residential home mortgage?
Yeah, so SBA is always going to be higher rate because they can do the 100% financing. They're lending to people who don't qualify conventionally. So if your commercial space qualifies conventionally, you're not supposed to then get an SBA loan. It's for those small businesses who don't qualify conventionally. And so that's why the rates are always going to be a little bit higher. They are usually tied to prime. So there is possibility for some lenders do fixed rates and some do adjustable. We do adjustable. So it's usually like prime +2, prime +2.25. When prime goes up, the rate goes up. When prime goes down, then the rate also goes down. So that obviously that's like the biggest pitfall of SBA lending is the rate. You're going to get a better rate if you can go conventionally or go like to a regular lender. But the plus on the other side is usually commercial conventional lenders, they have a balloon period, right? Where you may have like a 10-year amortization, but a 5-year balloon, and debt covenants, where if your financials fall below like a 1.2 debt coverage ratio, they're going to ask you to leave or refinance. SBA, on the other hand, protects a small business from never having to be asked to leave unless you're in default, which meaning unless you're like 60 to 90 days past due on your loan. And there's no debt covenants in SBA, and it's fully amortizing over 25 years. So it's a 25-year term, 25-year amortization. So your principal and interest payments are amortized over that full amount.
Now, is it always a floating rate, or is there ever any opportunity for fixed rate debt?
So there are opportunities for fixed rate debt. That's a lender credit box thing. So SBA allows it, but each SBA lender is different on when they can offer it. Most SBA lenders will do that for like the cream of the crop type of projects where you're fully secure with the real estate you're buying. It's really strong debt coverage. They may offer you a fixed rate. They also can do fixed rates for certain amounts of time. So let's say they fix it for 5 years and then there's a reset depending on what prime is 5 years from now. And then other SBA lenders just say, you know what, prime +2 for the whole life of the loan. And then that would adjust quarterly on the adjustable ones. So let's say if prime were to change right now, your new payment wouldn't change until April 1st. So it changes the first day of the following quarter.
Now, with a lot of commercial loans, there are prepayment penalties. Does something like that exist in the SBA world as well?
Yes. So only on the commercial real estate deals, it does for the first 3 years only. And it's only if you were to refinance. There's no prepayment penalty if you want to make a lump sum towards your principal balance, but it's really if you're just refinancing the loan. So in the first year, it's 5% of the principal balance. Second year, it is 3%. And then the third year, it's 1% of the principal balance. After year 3, it's designed for you to be able to then refinance for a better rate with a conventional lender. We see oftentimes the typical lifespan is somebody refinancing after 4 to 6 years to save on rate. Because by that time, hopefully their business is a little bit more mature to qualify and there's some equity in their building.
Those prepayment penalties are pretty attractive compared to a lot of commercial loans. What about the idea of interest-only payments? Are there any plans or any loans that do interest-only for a period of time?
Only if the loan includes construction or minor renovations.
Gotcha.
And it's usually capped at like a 6 to 12-month period, depending on how long that renovation period will take.
Okay. Eugenio is asking, what if the holding entity has 2 real property assets and the operating entity decides to lease one of the two? Would that qualify?
So that's a great question because your EPC, which is your real estate holding entity, can only hold the business that the SBA is financing with your operating entity. It is not allowed to hold more than one property at a time.
Very interesting. Okay.
Mm-hmm.
So if you were to expand the floor space of your business, you couldn't do that by acquiring a second site. Well, I guess you'd finance it on a separate loan, right?
Correct. Yep. So you could get a second site, but then you would have to create a new real estate holding LLC to purchase it. You can keep your operating entity, but your new LLC would have to be the real estate holding one, and then it could rent to that operating entity. So you could have 2 separate real estate holding entities renting out to the same operating entity.
Okay. I guess that brings up the question in residential mortgages, usually, Fannie and Freddie are only going to allow a individual to have 10 loans in their name and maybe a spouse to have, also 10 loans. So maximum of 20 for a married couple, perhaps. Are there any such limits on SBA loans?
So it's just dollar amount. So at any time, one individual cannot have more than 5 million outstanding at any time. So that could mean 5 $1 million loans, or that could mean like 20 loans, depending on how large those loans are. But it's all about the dollar exposure, which is 5 million at any one time.
Okay. Misi is asking, as a summary, what are the pros and cons of SBA versus other options typically?
So I know I mentioned a little bit earlier, but the biggest pros, I guess, are 100% financing. And this is very commercial real estate geared. And if you guys have other questions about SBA in general, but I want to try to stay focused on the real estate pros for it. Cash flow, the minimum has to be a 1.15. Other lenders usually look at a minimum of like a 1.25, depending on where you're located. So the DCR ratios are a little bit lower. You can do 100% financing. Our liquidation value is a little bit higher. So we would take 85% of the appraised amount, and that gets attributed to whatever the loan amount is. So I see a lot of commercial lenders are doing anywhere between like 60 to 75% in my area. And so we can go up to 85%. We will not turn you down for lack of collateral either, where other lenders, it's like a hard stop if you don't have enough collateral to collateralize the loan. And like the credit stuff, there's always like, if you can tell me a good story and be honest about what's going on, then we usually can mitigate that issue so we can get around we're not very black and white with the credit score. Also down payments. So I know I didn't get into down payments at all yet, but usually if it's an existing business, you have equity on your balance sheet, you can do up to 100% financing. If you don't have equity on your balance sheet, it's a requirement of 10% down, which most commercial lenders are requiring anywhere to 20-25% down. If you're a new business looking to purchase real estate, it's also just a requirement of 10% down. Same thing for those business acquisitions that include a real estate component, 10% of total project costs.
All right. I like how you can work with people when they have a story for why their credit may have a ding on it. Just to share my story, Amazon gave me such a good deal on their credit card, right? And then I missed the first 30 days back in 2016, and it's still there. But this year it's rolling off, so I'm happy about that. Is that the sort of scenario you're talking about, or are you talking about something a little more complex?
No, that would be a perfect one where they see a blemish and they're like, well, what happened? All the time, especially like during, like we see a lot also more stories where maybe they were behind on their mortgage like 4 years ago, but that month they were also going through a divorce or they also lost their job. And like, but before, so we really look at like that one time stamped item. And then we look at before and after what happened. And if there's been timely payments before and after, then to me, that's a life happened to you type of situation and not a character issue.
Right, right.
Or forgetting to pay your Amazon card, and that's just a forgetful life thing, right? That's
right.
Okay.
What is 1 30-day late? Anyway,
Yeah.
let's go through a couple of examples, and feel free to put your questions in the chat here. There have been a lot of numbers that have been thrown around, but I think it would clarify things a little bit. Most of the people that are here are busy professionals. They've got full-time jobs. Most of the people are here from Intel. And they might be looking at SBA as a way of, creating an investment for themselves, right? Maybe they found a bakery, like you said, or they found a small business. Maybe they want to help a friend who's got a small business. Do you have any scenarios where, somebody who's got a job, like most of the people here, that's good paying, wants to go help a friend, and that involves an SBA loan? Could you give a scenario like that?
Yeah, so we see oftentimes they're called minority investors. And so it also kind of depends on what you want your exposure to be. So for example, right now I'm working on a transaction in Pennsylvania where it is a restaurant acquisition, includes commercial real estate. This guy has quite a bit of money and he is the minority investor in the transaction, meaning less than 20% ownership. The general manager of the place really wants to buy the business, but she doesn't have enough money. She's general manager at a restaurant, doesn't have a lot in her savings. And so he is coming in as the equity infuser, putting down the full down payment. I think their down payment's about like $150,000 for a $1.4 million transaction. He's putting that down and she's already been running the place. Owners are absentee. She's been running it for years. And so it's a very kind of just like seamless transition. Those are the kind of things we love where it's like an existing employee buying the company. And if they don't have enough to do it on their own, then they bring in a partner or somebody that they trust to help them get it done. Same thing with like a friend. If you did want to own more than that, so anybody who owns 20% or more has to personally guarantee. So that means like you are signing off on a personal guarantee for the loan. So that's why I kind of go into those details with the percentages, because it depends on how much help you want to give your friend. And so if you're okay PGing the loan and you want more ownership stake of the business, then that's great. And you can go in like 50-50 with them or whatever ownership percentage you wanted. But you would then have to personally guarantee the loan. So it kind of depends on the degree of help that you're looking to give. If that makes sense.
Yeah, I love that scenario that you brought up of an employee who wants to buy the business. And so they bring in an equity partner to help them out with the transaction and it goes through the SBA. That's a great story. Misi, can you clarify your question a little bit here? You're asking about giving out loans versus jobs.
Sorry, I think compared to other banks, I think I was having two thoughts in my head. Because SBA is more government incentivized, I feel. So during recession, the government may be more wanting to have you guys stimulate the economy compared to banks. I'm not sure because, with looming recession and just wanting to get an idea of how you guys are compared to banks at different cycles.
Yeah, I totally get your question. So we are actually counter-cyclical, basically SBA. So during the hard times where a lot of people are getting said no to banks, that's when we shine and can say yes to some of those credits. And that's mostly because, I'm going to use Fundex, our group, for an example. It's Fundex's money that they're lending out to the small businesses, right? But just like how FHA is backed by the government, we are backed by the SBA, 75% of the total exposure. So if we're extending $1 million loan, we're backed $750,000 if that loan were to go bad. But that's why there's all these rules and regulations on top of it that we have to make sure we meet so that if the loan does go bad, our guarantee is in place and we're not out that full $1 million. And so it's basically counter-cyclical where banks are saying no, that's where we can say yes. And so our credit box, obviously, if a recession is coming, we tighten slightly here and there, but we're always trying to figure out a way to get things to work, especially because that's what the SBA is for. It's there so that small businesses can continue to get financing when their local community bank just can't do it because of what's going on in the industry right now. And then we hope that in a couple of years afterwards that they can refinance and bank locally again. So it's not something that people do forever. And part of the reason is because of the higher rates. And so it's never a bad thing if you're refinancing. It's always like, great, you qualify conventionally now. This is awesome. Like SBA is supposed to be a stepping stool to get that small business to that place. Hopefully that answered your question.
All right. Manjunatha is asking, does the SBA hold a good for franchise businesses like a UPS store?
Yeah, so there is actually something called the SBA Franchise Directory. You can literally Google SBA Franchise Directory, and it is like a 1,000-page PDF of all of the franchises that have submitted to get financing for SBA. And so in order to get financing for a franchise, you have to be on that directory. If you're not on that directory, then there's a process you can go through to get approved to do it. And you can also see which ones, there's Ys and Ns. Awesome, perfect. And so you get to see which ones have already been submitted and said no, so that you don't go through the process when they've already reviewed something. The intent of that is some franchises like to really manage most of the finances and the operations of that company. For example, I think it's like a Quick Stop. They're not an eligible franchise because the franchisor has too much control of the financials of the company. SBA wants to make sure that our small business buyer has most of the control. So we see a lot of like daycares, water ice stations, those types of things are usually approved on there because the franchisee, the owner, has more control of the finances. They don't want somebody else controlling your finances, basically, is the intent of that.
Okay. Do you have more to your presentation, or should we continue taking questions?
I don't even know. Let me see. I have
we took questions for a long time.
What do I have? I could go high level over like our process if you want. So that folks understand, and the process is similar also to other shops.
Sounds good.
So the first step is a pre-approval, which is the same thing as getting a term sheet to buy real estate. And that's where we then look at that short needs list from the business and the buyer. And so we at our shop try to do this within 24 to 48 hours from the day we receive that information. So every lender, they want to get that deal off the sheet. They want it off the street. They want to get a deal into underwriting. And so we also take a little bit of a deeper dive than other places. So every single term sheet that we issue also gets reviewed by whoever in-house gets to approve that loan. So we have certain approval authority that our credit manager approves and certain approval authority that our chief of credit approves. Depending on that loan amount, I'm reviewing that term sheet, the risks of the deal, the hair of it, the strengths of it, all with that individual before I issue that term sheet. And so we have a pretty cool rating. I think we're about like 98% of term sheets that have gone out that get signed by that prospective borrower end up going through underwriting and getting approved, because we take such a deep dive in the beginning. So I may drill you with questions a few hours after you call me, but we like to get all the hair out in the beginning so you're not sitting in underwriting for a week and then you get declined. So you would have an answer within 48 hours. And then it starts underwriting. And so this is the official process. And so there's more SBA documents and application forms that you have to fill out for the underwriting process. That process usually takes 5 to 7 business days. And so we have a pretty cool team, which I'll talk about in a moment, but I kind of have my own personal underwriter. So every deal that I bring in, my underwriter, Mike, gets to underwrite. Which is awesome because we get to build the rapport with each other. We know each other's styles. I know what questions he's going to ask. So I try to get ahead of all of those in that pre-approval, pre-underwriting stage. And then approval happens and then closing. Everyone always asks, how long does it take to get an SBA loan? And it's such a question because it really depends on who we're working with. So if everything were to go perfectly, 30 to 45 days. Some take longer, some can take up to 90 days. The closing really is up to how quickly that borrower can nail down that closing checklist. And so after a loan gets approved, 24 to 48 hours later, we're very like KPI driven at our shop. You would get a closing checklist. Once that closing checklist, everything on that is in and approved, we close 5 days later. So the things on that checklist are like insurance policies, all of your entity paperwork, your equity injection documentation, everything we need to kind of like dot our I's and cross our T's to satisfy the SBA if we were to get it audited after the loan closes. Also, commercial real estate focused appraisal and environmental reports. We also need to make sure those are in and they are clean before closing. And so we usually give borrowers the option if they want to wait until they execute a commitment letter to order that appraisal, or if they want to do that during the underwriting phase to shave a week off of closing timeline. And it's completely up to the borrower. So the only risk to the borrower at that time is they risk losing the money that they paid for that appraisal if for some reason they don't get approved. So that's kind of what our process and how we look at it. And so we also are a little different than other shops because we have it's pretty close to like a 1-to-1 ratio, where a lot of other shops still have 3 lending officers per 1 underwriter. And so as I just mentioned, it's almost like 1-to-1 for our BDOs, which is myself, the lending officer, underwriters, closing specialists. And then we also have loan coordinators who are coordinating all the internal partners, the third-party reports, and making sure all of the documents are perfect to get through the process. And then this was just an example of a recently closed commercial real estate deal that also included other uses of proceeds in their loan amount. So it was a total of a $2.9 million loan that company started in 2017. The building itself was $2 million, and then they had some allocations towards equipment, inventory, working capital. I get a lot of questions on working capital and like, what is that? How can that be used? So working capital, if you see $250 right there, the day of closing, you get $250,000 into your business banking account to be used for working capital. However, during the underwriting phase, we want to know where those dollars are going. So let's say you're like, you know what? By buying this building, we're going to be able to expand. I need to hire another manager to oversee this set of our services. This is going to help them with the first 6 months of their salary. This is going to help with our rent, our maintenance of the building. As we would allocate that out. We have templates for everything. And so that's working capital funds that you get into your business banking account the day that the loan closes. This particular example was 100% financing. At the time, this was prime plus 2.75. And like I mentioned earlier, all of these do have 3-year prepayment penalties on the 25-year deals. And so if a loan does not include commercial real estate and it's strictly just a business acquisition, those terms are actually 10 years and there's no prepayment penalty on it. And so that's like no real estate involved at all. But commercial real estate, 25-year term, 25-year amortization, 3-year prepayment penalty.
Okay, I've got 2 questions actually there really quickly. With the
Yeah.
working capital, oftentimes, at least with an apartment, syndication or some sort of larger commercial rehab that you're doing, the bank will take that money into escrow and keep it in an escrow account, and then you will pay for it out of pocket and then submit your reimbursements to the bank. Is that how this operates here, or is the owner of the entity receiving that amount at closing?
No, so with SBA, so there's two different kinds of SBA loans. The single disbursement, which is most of what we do. So that means like there's no construction involved. So the example that I just went through, that 250,000, that was just deposited into that business's business bank account the day of closing. It was wired in. So when the title company was getting wired, they were getting wired as well. And so they do sign stuff at closing, like affidavits that they're going to use those funds for the business. They're going to use it what they said they were going to use it for. And so that's all, federal legal paperwork. So we're trusting the small business to honor it. But that basically, they get it the day of closing. We don't ask for receipts. We don't follow up with them to make sure they use it that way. We do trust that they use it that way since they're certifying that they will.
Okay. And then the other question I had was that this was a business that was closing, and I didn't notice that there was any allocation for goodwill or their business intangible assets. Is that common to not have those included?
No, so this one was actually an existing company, the one that I just showed. I don't know if you're talking about that one, but the one that I just showed, this is an existing business.
Okay.
And so they weren't buying another business. They were just buying the real estate and expanding.
Okay.
So but if you are buying a business, so I'm looking at one right now based in New York that the real estate is attributed 800,000 and the goodwill / assets are contributed to 700,000. So since I'm $100,000 over, I'm able to amortize that over 25 years, and goodwill is attributed to that 700,000.
Gotcha. All right. I'll let you go on. Unless anybody else has questions.
This is it really. So then, we try to pride ourselves as industry experts. I think myself and all my colleagues, all of us, SBA is all we've done. And the cool thing about working with a non-bank SBA lender is SBA 7A is literally all we do. So we're not offering lines of credit. We're not offering home mortgages. We're not offering the bells and the whistles and the everything else in the bank accounts, just SBA 7A lending. So when you're working with us, you're working with people who just are like breathing this in every day. We have like a technology platform for all the secure paperwork, and you can see where your loan is at all times. And then we really kind of pride ourselves in the collateral neutral underwriting, where we rarely ever turn down a deal if there's just not enough collateral. For example, we do a lot of business acquisitions with little to no collateral. I just got one approved today, actually. It's based in Nevada it's about 2.4 million, and we have literally like $200,000 of collateral on it, but we're able to mitigate it because there's such strong cash flow. And then that's it. And then there's my contact info below. I don't know if you guys have more questions, and I'm sorry if I talked over.
No. Yeah, I was just going to say, can you please display your contact information? And of course, this is for any of you who might be affected by CPM. Of course, there's always the route of buying your own business, and this is the perfect type of opportunity for doing that. So you've given us a lot to think about. Any questions from people in the audience?
I have a question. Since you work with so many different types of business and people trying to become business owners, where do you recommend finding business with strong cash flows to purchase?
So there's a lot in the country, there's probably like 1 million of them. They're called business brokers, and there's a lot of like larger franchises that have them. It depends on the industry that you're looking for. So some of the big ones are like First Choice Business Brokers, Transworld, Murphy, that have offices like all over. And so those business brokers usually have a listing of businesses for sale. And in that listing, if you were interested on that, they would then provide you with what's called a SIM. And so in that, it's basically like PDF package of like 10 pages that goes over all the financials of the company that you're looking at. Most of the time, those business brokers are aligning those financials with the financials in the actual tax returns. And something that I actually do a lot, especially the last year, is that when somebody's looking to buy a business and they'll send me the SIM, they're like, hey, do you think this could cash flow for, I don't know, a $2 million loan? Like, let me know your thoughts. I'll run through the numbers. I'll ask the broker directly, like, hey, I'm vetting this out for a loan. I want to see the tax returns. I always want to match up to the tax returns. I never just believe what's in the sim just because a broker put it there, which gets on the nerves of some business brokers. But then it's also, I'm not giving you a term sheet based off of something they put together. I'm giving it to you based off of the raw data. So I asked to see that, and then I can walk you through how to look at the numbers and make sure there's enough cash flow for what you want to invest in. There's also a website, I want to say it's called like bizbuysell.com. And then you put in like the county or the state, the industry that you're looking for, and literally hundreds of businesses will show up that are for sale. There's a lot right now. Business acquisitions is like the next most use of proceeds that SBA 7A lending does.
Mm-hmm. Yeah, especially with a lot of baby boomers who started just retiring.
Everybody's retiring.
Possibility here. People who are so hands-on with the business.
Mm-hmm.
Thank you. This is very helpful.
There's Biz Buy Sell, there's Flippa, there's Acquira, there's a ton of them out there. I was actually shocked to find out how many were out there when I started looking into this. So if you want to go be your own business owner, there's no shortage of people that can help you on that journey.
Yeah, it's like a little overwhelming. And if you're in a specific area, I work with a lot of different business advisors and brokers across the country. There's some that I do really trust and make sure that they're not just trying to sell their company, but they're also finding the right fit for it. I'd be happy to introduce you to people I've worked with in the past, depending on your area.
All right. Hey, everybody, could you take yourselves off of mute and thank Mary for coming in here and sharing with us today?
Very, very helpful.
Thank you, Mary.
Thank you, Mary.
Thank you, Mary.
Thank you very much, Mary, for coming in, sharing with our group.
Thank you.
We could stay on. We could stay on for a little bit more if you want to, or we could close the meeting off. Maybe we'll just hang for a few moments to see if anybody has anything to say.
Hey, Daniel, I'm curious about your experiences. Are you looking at taking on SBA loans right now? And if so, how's that experience?
I am toying with the idea. I've actually done some underwriting of a couple of businesses here in the Portland area related to real estate. Just because I'm the type of person who's got, I'm starting about 5 different plans since I started since I'm leaving Intel. But I think some of them will work and some of them won't. And my main plan is just to be a real estate investor.
Yeah, you want the business to be more on the side, kind of.
And I want to understand all the different options for financing that are out there, right? If you can't acquire a loan through a traditional bank, maybe you can go to a credit union or an SBA loan, or have it financed through some other creative mean. Maybe you can create a partnership and bring in equity that way. The more you understand about your financing options, the more likely it is that you're going to be able to find a creative solution to any situation you're in. So I personally just like to be educated on these topics.
Good point. Education's power. Thank you, Daniel.
All right. Well, I guess that we will say have a wonderful weekend to all of you out there. For those of you that are in the Portland area, enjoy the snow.
Hey, Mary, can I ask you a question if you're still there?
Yeah, I'm here.
Okay. What about developing like RV park? I know SBA loan or USDA loan is typically for developing RV parks. So I mean, it's usually for RV park purchases. So if it's something developing based, you don't have P&L, historical P&L, T12, T1, T24. What do you go about that?
So that'll depend on the SBA lender. So it's eligible per SBA. We don't do a lot of strict startups, but you can finance that. It must be called an RV park though, and not a mobile home park. A mobile home park would make it ineligible. So as long as it's called an RV park and no more than 10% of the rentals are on a longer than weekly basis, then it would be eligible. So they basically, it's like toying between that passive income versus operating income.
Yeah, understand. Okay, thank you. I'll follow up if you have more questions. Thank you, guys. Thank you, Daniel. Thank you, Mary.
Yeah, thank you so much for having me. You guys asked amazing questions, and I really enjoyed it. So thank you.
Thank you, everybody. Have a great weekend.
Thank you, Daniel. Bye.